As India pushes her developmental goals in the midst of a predicted slowdown in the GDP, a clear, simple, and internationally tax competitive tax regime that promotes economic growth, it promotes ease of doing business in India, have become key to the country. Some big ticket changes that could lead to those goals are as follows. First, relooking India's tax policy around tax neutral reorganizations. Currently, under Indian tax rules, tax neutrality is only accorded to court approved mergers and demergers. However, these rules are now dated, and there are several ways in which business reorganizations occur. This could be through asset sales, business transfers, and through share swaps. It's time that government relooks its tax policy around tax neutral reorganizations where there's continuity of shareholder interest and continuity of business to promote more value enhancing business reorganizations in the country. The second goal, in which the government seems to be currently working on very actively, is to reduce compliance complexity. If you look at the TDS regime over the last few years, there has been a major overhaul on the purpose that it serves. So what initially began as a mechanism for advanced collection of taxes has now become a mechanism for collecting data on transactions that occur in the economy that then gives the government intelligible information when self-assessment returns are filed. Keeping this in mind, there is scope for the TDS regime to be simplified and reduce it into one or two or just three rates for purposes of deduction. This will not only enhance cash flow in the hands of businesses, but also reduce disputes that arise on account of characterization of payments that may be falling under different slab rates as far as TDS is concerned. When we're on the topic of compliance complexity, it would also be helpful for the government to consider proposals that look to make tax compliances easier for foreign investors or foreign businesses. So for instance, we are all aware that this year there was a requirement for companies to dematerialize their shares. Several PANs were issued for foreign enterprises, and it's unclear whether they're required to file a tax return even in situations where they don't have any income in India. It's difficult for foreign enterprises to be making payments of taxes in India through foreign bank accounts. So all of these small or simple things, if these are resolved, it would go a long way in promoting ease of doing business in India. When you're also talking about foreign enterprises, I think one of the key pain points has been around attribution of profits to permanent establishments. So when we open up the country for setting up of GCCs, for setting up of manufacturing operations, one key risk that foreign enterprises live with is what happens if they trigger a permanent establishment in India. While the government did come out with a policy paper which suggested that formulary apportionment method should be a clear way for attributing profits, we haven't really seen any rules, and therefore this continues to be a gray area in law. Finally, I think one of the other key focuses for the government should be thinking about alternative dispute resolution in the tax space. So tax disputes continue to occupy the time, energy, and resources of both the government as well as taxpayers. And while we have now several ADR mechanisms such as advanced ruling, MAP, APAs, transfer pricing safe harbors, we still need alternative solutions, for instance, tax mediation or a permanent tax settlement mechanism like the Vivad se Vishwas.